L&T reported its numbers. Some of you have asked those doubts on that, and we did solve about buying the stock as well, or whether you should look to hold. But weak numbers in Q4 was on the cards. L&T stocks is spiraling downwards, and as the investors remain concerned about the margin pressure, my colleague Avanne Dubash caught up with the CFO and whole-time director R Shankar Raman to discuss their numbers and what is the way forward for the company. How will that be going forward as well? Because clearly Q4 was a bit under pressure. As of now also you can see that the stock is down 4.8% in trade as well. Let's go across and listen in to this interesting chat that Avanne did have on the numbers with the CFO of the company.
In conversation then with Mr. R Shankar Raman, the CFO and whole-time director at L&T. Thank you so much for joining in. Now, I think the margin disappointment is clearly what the street is reading into. In the previous calls, you have been very confident about margins recovering quite substantially due to internal efficiencies and a number of other factors. Why then have you guided for lower margins this time around?
If you recall the last quarterly conversation that we had around the results of the third quarter, I did mention about a 50 basis points pressure that we are experiencing in the margins of our major EPC business. Let me explain to you that how this problem is a transitionary problem and has to be viewed in perspective. The order book, much of it that is getting executed in FY23 has been based on commitments that we had picked up the year ahead, that is in FY22. And normally the projects being 24-36 months duration, the purchase commitments are also made that much earlier. So the consumption of materials that had gone into FY23 is largely arising out of commitments made in FY22 and a little beyond for long lead items. And you know that the inflationary pressures were intense in FY22 and first half of FY23. The commodity prices have corrected their courses in the second half of FY23, and they continue to remain within moderate levels currently. So as we execute the old orders and the order backlog, it is but inevitable that the cost that we had committed on those projects gets to be consumed. The fact is that much of these projects have some element of flexibility to converse with the customers about the time overruns, because COVID did cause a lot of time overrun. So time extensions was required. And also the fact that very unusual spike in the material prices, supply chain getting disoriented because of the war in Europe, etc. These are unusual situations. So I think the clients also understand and appreciate. So our focus has been in FY23 to complete our commitments as much as we have scheduled to, so that the conversations around what compensations to be made to the contractor can happen at the back end of the contract. So my own sense is that we should be able to recover some portion of this margin decline over the future period. But the way the accounting standards are and our accounting policies are, the cost have to be absorbed as they are incurred, and the relief would come in the subsequent period. And nature of the projects being what they are, all of the relief will not get added up in one quarter where you will see a spike. In fact, you will see slow drip of the credits over future quarters. And I might hasten to add here, because the market's expectation is also to be realistic, that the subsequent 2 quarters also I expect the margins to be soft, because that is where the peak of the execution of the past contracts are happening. It's only in 24-25 that you will see the benefit of the current contracts that we have won that will start playing out in the P&L charts. So as a company, we are bracing ourselves for first half of next year, the current year, as well to be a little tougher on the margin front. But then I think things will ease going forward. We are confident overall that the jobs that we are executing will turn out to be profitable. How far they are to the estimated profit is something that we need to see as we go forward.
Okay, so that's the clarity. So since you've said that the second half of FY24 to 25, you will see your margins recover, can you just walk us through the best case scenario in terms of what you're working with by way of a number?
See, we had guided before all of this happened that our margins would be around 9.5%. Okay, and we are running at about 8.6% today. So the effort would be over 2 steps or 2 years to get back to those levels. The construct of the EPC contract does not permit margins to be 12, 13, 14% that the manufacturing businesses have. And neither does the construct have margins to be around 20%, which the services business have. In our revenue mix, you would have possibly noticed that a third of our revenues in the group level comes from services, which has a richer margin by comparison. About 10% or so comes from manufacturing, which has the mid-teen margins. And two-thirds of our business is from construction projects, EPC business, which has, as I mentioned to you, the margin level around this 9% band. So on a blended basis, I think we should be able to recover as we ramp up our services business and hopefully the manufacturing business on the back of the push that the government is giving for manufacturing sector. Hopefully, if those move up, then the ratios become a little more balanced, and that should enable the overall recovery of the margins. But in a given year, given the wide diversity of businesses that we have, we would have pockets where margins are modest and pockets where margins are healthy. So the blend is something that we'll have to manage as we have been doing all this while. And going forward, we expect to do that as well.
Point taken. Now, it's certainly been a flourish when it comes to the order inflow this time around, and the prospects for your order inflows down the line as well seem to be fairly strong. Owing to the tailwinds from the infrastructure sector, what is it that you're working with in terms of what will be your order inflow drivers down the line, and what are you targeting?
See, I think the biggest upside that we have is the congruence of where our skill sets are and where the country seems to be investing. I think infrastructure is the place where a lot of investments are happening, both at the central level, at the state level. And that's our strong point in any case. So I think we have an environment where the investments and what we can deliver are actually meeting quite nicely. What is going to be the key driver for us to be relevant in this context is going to be obviously cost competitiveness. End of the day, I think most of the projects are determined based on the L1 prices. So there is a bid, there is a tender, and we'll have to submit our prices. And the person who puts in the most competitive prices walks away with the project. So I think cost competitiveness is going to be key to enable us to be cost competitive, because price is not something we are controlling, the clients are controlling. And competition will make sure that the prices stay competitive. What is within our control is the cost levers and productivity levers. What we are doing as a company, and we are investing in these issues, and that is also partly reflected in the margins getting softer, is investment on automation, investment on technology, investment on better methods of constructing and executing projects. Now, all of this would mean that the engineering quality and excellence that we need to bring in terms of technology has to go a notch up. And as you know, nothing is free. Technology investment also means some costs to be allocated for that, which we are doing. We do think that given the opportunity spectrum that we have for the country over the next 3-5 years, and given the fact that our capacity is well geared towards these opportunities, the focus of the company would be on cost management and cash management.
Cost management and cash management. So then do you think that we can see that 10 to 12% guidance for FY24 in terms of order inflow? And will we see a higher inflow coming in from the overseas market for FY24?
We are almost at about 38% of our inflows coming in from international markets, even as we closed FY23. I do think that the ratio of about 1/3, 2/3 will continue to play out going forward in FY24 as well. The guidance that we are given is 10 to 12% increase over the 231,000 crores of orders that we have won last year. And if you recall, last year we had given a similar guidance, but we've been able to, fortunately, win more orders than what we had anticipated, and close the year with about 19% order inflow. I must draw your attention that the current year, towards the fag end of the year, we are going to head towards the country's union election, and there are a lot of state elections coming as well. So, in a manner of speaking, the year ahead, the FY24, could be a year short of maybe just a bit short of 12 months full calendar that we normally have in a year. So, given that the opportunities are quite encouraging, and we are quite hungry for doing more, we should be able to possibly meet this 10 to 12% guidance that we have given. And if there is a pickup in the pace of award, as it was the case in FY23, FY23 we were able to beat the guidance because the award to tender ratio became that much more promising. Almost 9 lakh crore worth of tenders were put out, and 4.5 lakh crore worth of tenders were actually awarded in FY22. Whereas in FY23, the year that we completed, it just doubled. We were able to get almost 9 lakh crore worth of orders put out, and hence that helped us order inflow grow. So it all depends on how the macro environment plays out and how the government is going to pursue the investment-led recovery that has worked so well for us so far. And hopefully with inflation moderating and interest rate holding ground, we should be able to see better times. So at the floor, we should be able to do this 10 to 12%.
Your cash generation is high. Where are you looking to invest?
Actually, the investment program that we have is pretty modest. The normal capital expenditure that we incur is about 3,000 crores a year, and those are on strategic equipments that are required for us to execute our projects. Those I think we would continue to do. The core businesses does not need any further investments for capacity. We are trying to ride the energy transition business, which means that we are trying to invest in a factory which manufactures electrolyzer, which is used for hydrogen generation. That would take in some investments. Likewise, we are trying to scale up our data center offerings as a part of normal IT offerings. The data center investments is also something that we will do. We are building up 30 megawatts worth of data center at the moment. These are some investments that are new as compared to what we have done in the past. But bulk of the cash that we will generate will be recycled within working capital. And also, I think there is an opportunity for us to share the surplus cash with the shareholders. And you would have noticed even this year, FY23, the dividend payout ratio is as high as 43%. Historically, we've been paying out 25-30%. So we've stepped that up as well. So I think we will also find ways of generating cash and rewarding the shareholders. I don't think we are going to change track on our asset-light strategy. So I don't see any investments that we will be making on hard physical infra assets. It'll be more EPC-led, services-led, and the cash flow would be for stakeholders.